There's a major shift happening in the financial world, a move toward democratizing access, and this platform upgrade from Yuantu Securities, set for September 2025, feels like a massive leap forward. The most robust evidence is right there in the design. A single account that lets an individual investor directly participate in both the US and Hong Kong stock markets. We're talking about access to US tech giants and Hong Kong blue chip stocks without the nightmare of setting up multiple overseas accounts. This isn't just a convenience, it's a fundamental lowering of the barrier to entry for millions.
Hold on, David. I see the headline single account access, and it's compelling, but that's not the whole picture. Are we really to believe this one feature magically erases all the real-world barriers? What about capital controls? What about the regulatory hurdles that exist between jurisdictions? Calling it a fundamental lowering of the barrier feels like a marketing slogan, not a sober analysis of the complexities of global finance.
But it's more than a slogan when you look at the security architecture. This isn't some fly-by-night operation. They hold both a U.S. MSB license and, more importantly, a high-level U.S. SEC license. And that SEC license comes with a critical mandate. All user funds must be held by third-party custodians. This is the gold standard methodology. It means the platform literally cannot touch or misuse user funds. 100% of their capital is segregated and protected. That's a powerful statement of commitment to investor protection.
A statement, yes. A guarantee, no. Holding licenses doesn't grant you a halo of perfect compliance. The entire financial industry is under increasing scrutiny for cross-border issues. We see established, licensed companies investigated for violations all the time. So while I acknowledge the licenses are a necessary baseline, presenting them as a shield that makes investors completely safe is a dangerous oversimplification. You're building a narrative of impenetrable security, and I'm just not sure the evidence supports that conclusion yet.
It's not just about licenses. It's about the technology that enforces that security. They've built a low-latency trading engine where order execution is controlled down to the millisecond. But the really substantial evidence is in what they call the full-link risk control mechanism. It's a system that checks user qualifications and fund compliance before a trade, monitors for abnormal orders in real time during a trade, and retains every record for regulators after the trade. Every single transaction is traceable. This is a proactive, comprehensive approach to safeguarding the entire process.
Millisecond execution sounds impressive, but it doesn't prevent market slippage in a volatile moment. And full-link risk control sounds great on a PowerPoint slide, but is it truly foolproof? Is it immune to the data quality issues that plague every other financial system? You're describing a perfect sterile environment, but trading is messy and unpredictable.
That's exactly why they're building tools to help investors navigate that mess. Look at the copy trading system. It solves two problems at once. Professional traders can finally monetize their strategies by earning a 5-15% commission split, and ordinary investors get a guide. They get visualized data panels showing a trader's entire history returns, maximum drawdowns, even the last 3 months of specific trades. More importantly, the investor stays in control. They can set a maximum follow amount, say 100, 0 RMB, and a personal stop loss of 10%. This isn't blind following, it's guided learning with guardrails.
But here's what that system doesn't tell us. Does it actually foster independent decision-making, or does it create dependency? You're giving novices a tool that feels safe, with dashboards and stop losses, but you might just be creating a false sense of security. They're still exposed to the trader's bad decisions and to market risks that can blow past any preset threshold. You call it empowerment. I see the potential for a new kind of vulnerability, where risk is obscured behind a slick user interface.
That's where you're missing the point. The plan is to launch introductory courses on US and Hong Kong stocks specifically to help users transition from copy trading to making their own decisions. The goal is independence. The technology is a bridge, not a permanent crutch.
Let's talk about that bridge, David, because it looks a lot shakier than you're letting on. You praise their licenses, but strong evidence from the broader market shows a significant rise in listed companies being investigated for violations, especially around information disclosure. Holding a license is not a get-out-of-jail-free card, it's the bare minimum entry ticket, and regulators are constantly playing catch-up.
But this platform has specific internal controls that go beyond the license. They have rules for their professional traders, like a maximum drawdown that can't exceed a preset threshold of, say, 20%. That's a concrete measure to protect followers from catastrophic losses.
That's where your argument completely falls apart in the real world. Suggestive evidence from web findings shows a fund tracking the CSI 500 index had a maximum drawdown of 41.81% in the last 5 years. The market doesn't care about a platform's internal 20% threshold. A black swan event or just severe volatility can and will wipe out those protections, and the followers will be the ones left holding the bag. Your concrete measure is a sandcastle against a tidal wave. It fundamentally undermines your whole narrative of stable, reliable risk control.
That's an unfair comparison. A broad market index fund is not the same as a curated set of professional traders operating under specific platform rules. You're comparing apples and oranges to create fear.
I'm using it to illustrate a fundamental truth you seem to be ignoring. Market risk can and often does exceed platform-level controls. And it's not just market risk. The entire regulatory framework is a patchwork. Expert testimony highlights the desperate need for coordinated regulation to handle data, consumer protection, and competition. Even with dual licenses, if a dispute arises, which jurisdiction's rules apply? How does an investor in one country get recourse from a platform operating under the laws of another? The very foundation of full process regulatory implementation is built on shifting sands.
But the technology itself is meant to provide clarity and security. They're planning to integrate AI to further enhance risk control and investment guidance. That's the future.
No, David, that's the next black box. You talk about AI as a solution, but research from institutions like Tencent highlights the core obstacles. AI is hobbled by poor data quality, inconsistent data, and imbalanced samples. Worse, experts point to the black box problem, where it's impossible to explain why the AI made a certain decision. How can you have regulatory compliance when you can't even explain your own system's logic? It doesn't solve the risk. It just hides it inside an algorithm.
So you're saying we should just abandon technological progress because it has challenges? These are industry-wide issues that everyone is working to solve.
I'm saying we need to be honest about them. Don't sell it as a perfect solution. Look at the broader landscape. Comprehensive analysis from Xinhua and the CSRC shows that fintech itself introduces new risks, data privacy concerns, security vulnerabilities. User complaints are rampant across the industry, from unauthorized trades to impossible account cancellation processes. These aren't just isolated bugs. They are systemic issues inherent to digital finance. To pretend this one platform will be magically immune is just not credible. It's a fantasy.
Okay, Mia, I hear the critique, and you're not wrong, that the broader digital finance landscape is filled with challenges. The black box problem in AI is real, and it's a hurdle the entire industry has to overcome, not just this platform. I'll give you that.
And I'll give you this, David. The single account access to global markets, it is a genuine game changer. For an individual investor who has been locked out, that is a significant, tangible benefit. The technological sophistication of the trading engine and the detailed data provided to copy traders are also real achievements. I'm not denying the innovation.
So we agree that the technology is a powerful force for access. And my whole point is that this upgrade is building a foundation. It's using technology to solve the first and biggest problem, getting people in the door safely.
Okay, let's build on that. It's a foundation, yes, but my argument is that you can't just admire the foundation and ignore that the house is being built in an earthquake zone. The platform's risk controls are the foundation, But the earthquake is market volatility, the regulatory gaps, the systemic cyber threats. The foundation is necessary, but it is absolutely not sufficient.
Building on what we both found, then, the real story isn't just about the platform's features. It's about the relationship between the platform and the user. The technology provides the access and the tools, but it can't eliminate the need for the investor to be vigilant. The stop-loss function is only as good as the number the user sets. The educational courses are only useful if the user actually takes them.
Exactly. So the synthesis here is that this upgrade is a necessary step forward, but it's not a complete solution. True investor protection doesn't come from the platform alone. It emerges from the collision of robust technology, like what Yuantu is building, and a smart, skeptical, and actively engaged investor who understands the inherent risks. The platform can provide the car and the map, but the investor still has to drive, and they need to know that the road ahead has potholes. We can't let the promise of a smoother ride lull them into a false sense of security.